there, and welcome to the deep dive. We often talk about companies that are blazing new trails, but what about those operating in truly fascinating and sometimes fraught territory? Today, we're diving deep into a question that sits right at the heart of modern finance. Can a company build a durable, profitable business by serving the very customers traditional banks consider, well, too risky? We're going to unravel what's often called the subprime paradox with a deep dive into OppFi Inc. That's ticker symbol OPFI. And by the end, you'll understand if its high risk, high reward model is built on, a precarious foundation or if it has actually forged a surprising competitive moat. We'll be looking at all the sources you send our way, exploring everything from its business model to its financial health, market sentiment, and the significant risks it faces. As of Friday, July 25th, 2025, OppFi's share price closed at $11.27, but our analysis later on will reveal an estimated intrinsic value range that might just surprise you.
That's right. Our mission today is really to cut through the noise and deliver the most important insights on OppFi. It's a company that has positioned itself as, well, a key player in serving approximately 60 million everyday Americans who simply lack access to traditional credit. We'll synthesize the complexities, connect the dots, and ensure you walk away well-informed about this pretty unique financial technology platform.
Okay, let's start by understanding the engine driving this company.
Understanding the OppFi machine, a business analysis.
So OppFi is a financial technology platform, and that's a key distinction, right? They're not a direct lender themselves.
Yeah, exactly. And that distinction matters a lot.
Yeah, because their entire core business is built on this bank partner model. It sounds like a strategic necessity, really.
It absolutely is. It allows them to navigate that incredibly complex web of state-by-state lending regulations and, importantly, interest rate caps.
Things that would otherwise just choke their operations, I imagine.
Totally. Think of it as their strategic shield against a whole lot of legal landmines.
Okay, so OppFi handles the tech, the marketing, the application process, even servicing the loans.
Right. But their bank partners are the ones who officially originate those loans.
Gotcha. So their primary revenue stream then comes directly from the interest and loan-related income generated from that portfolio they help manage.
Precisely. And a critical element here is OppFi's flagship product, OppLoans.
Okay, tell us about those.
These are online, unsecured, personal installment loans. Typically, you're looking at ranges from, say, $500 up to maybe $5,000. Designed for consumers often turned away by mainstream banks.
Right, and what makes them different in this subprime space?
A few things. They offer rapid funding, often same day for approved applicants. That speed is huge for their customers.
Yeah, I bet.
Their terms are also notably transparent. No hidden fees, no origination fees, no late fees, no prepayment penalties. Plus, there's simple interest, fully amortizing loans.
Which is a big contrast to things like payday loans with those balloon payments, right?
Exactly. And crucially, they focus on trying to help customers build credit. They report payment history to all three major credit bureaus, TransUnion, Equifax, Experian.
That's significant.
Yeah. And they've also strategically diversified a bit. They acquired a 35% equity interest in Biddy Advance, which is a move into small business financing.
Interesting expansion. So that brings us right back to that subprime paradox you mentioned. OppFi is squarely targeting about 60 million everyday Americans, mostly with FICO scores below 650.
Right. And the average customer profile really highlights their vulnerability.
Tell me about that.
Average age is around 40 years old.
Yeah.
Annual income about $55,000. But here's the kicker. Less than 1 month of savings on average.
Wow, less than a month. That really drives home the importance of accessible credit for unexpected expenses.
It really does. So OppFi's value proposition is framed as facilitating safe, simple, and more affordable credit access.
Okay, affordable is always tricky with higher interest rates, but compared to predatory alternatives or just nothing? Maybe it is relatively safer and simpler.
That's the argument. They aim for a more structured, transparent experience. They even have something called the Turn-Up program.
What's that?
It actively checks if applicants might qualify for lower rate options, even if it means referring them to a competitor.
Referring them away. That's
Right.
unusual. But it builds trust, I suppose.
It seems to. It's a powerful customer-first kind of message, especially in this market segment.
Okay, zooming out a bit, what's the broader industry look like?
Well, the U.S. alternative lending platform market is projected to grow pretty fast. We're talking a compound annual growth rate of 25.4% from 2025 to 2030.
Wow, that's a strong tailwind.
Definitely. And we're seeing key fintech trends playing out here too, like AI for hyper-personalized underwriting, embedded finance, and this banking as a platform model, which OppFi basically embodies.
Competition must be fierce, though.
Yeah. Players like Upstart and Nova International, it's crowded space.
Mm.
But this brings us back to regulation. There's this massive elephant in the room, the true lender debate.
Explain that. What's the risk?
Okay, so regulators might argue that OppFi, despite its bank partners, is actually the real lender in the eyes of the law because they do so much of the work, right?
Right. And if that happens,
If that ruling goes against them, OppFi could suddenly be subject to state-level interest rate caps. And that would essentially make their high-yield business model completely unsustainable in many states. It's a huge, persistent threat, an existential one, really.
oof. Okay. That sounds like a major risk factor. But you mentioned barriers to entry.
Yeah, despite that risk, getting into this space isn't easy. You've got immense regulatory complexity across 50 states. You need substantial capital, and you need the tech sophistication for that AI-driven underwriting.
And OppFi seems to have leveraged those barriers. What are their core competitive advantages?
Well, first, their brand is surprisingly strong, especially in the subprime market where trust is absolutely paramount.
How do we know that?
They boast an industry-leading Net Promoter Score, or NPS, of 78, plus like 4.7 out of 5 stars on Trustpilot, an A+ Better Business Bureau rating.
Okay, those are pretty compelling metrics.
That brand strength translates into real customer loyalty. Then you have their cost advantages, largely driven by their tech.
The AI platform.
Exactly. It's impressive. Analyzes over 500 attributes using more than 15 billion data points collected over 13+ years.
15 billion data points.
Yeah. This massive data set fuels an automated approval rate of 79% as of Q1 2025. That means incredible efficiency.
So that proprietary data set, built over more than a decade, that's probably their most defensible asset.
You could definitely argue that. It's core to their whole operation.
Okay, we've mapped out the machine, but who's driving it? Let's turn our attention to the leadership team. Because in a company like OppFi, navigating these tricky waters, well, the people at the helm are crucial.
Who's at the helm? Management evaluation.
So OppFi is founder-led, which often signals a strong, long-term kind of vision, right?
That's often the case. Todd Schwartz is both the CEO and executive chairman. He actually returned to the CEO role in early 2022.
And his background, what's the story there?
His leadership philosophy seems deeply tied to the company's mission. He often shares this story about seeing a nurse pawn her wedding ring, which supposedly inspired him to create better financial solutions for the underserved.
And his motto?
You either win or you learn, which, suggests a culture of maybe embracing setbacks, learning from mistakes.
Interesting. What about the rest of the team?
They're incredibly seasoned. You've got folks who've held senior roles at places like Nova International, Avant, Capital One, HSBC. So deep financial services experience.
Okay. But what about their communication style and maybe more importantly, their reputation?
Yeah, this is where you see a real dual narrative. In public statements, earnings calls, management is consistently optimistic. They report record revenues, raise guidance, highlight operational successes.
Sounds positive. What's the other side?
Well, externally, especially from consumer advocacy groups, there's persistent criticism and legal challenges over the high APRs on their loans and that whole bank partner model we discussed.
So that model is controversial beyond just the regulatory risk.
Absolutely. So while they maintain that A+ BBB rating and stellar customer reviews from their direct customers, their broader market reputation is often shadowed by these criticisms. It creates a complex picture for investors.
Okay. Knowing how they make money is one thing, but how do they spend it? Let's talk capital allocation.
Sure. They continue to invest heavily in their core technology. The focus seems to be on refinement in credit modeling and improved operational efficiency. Makes sense, given the AI focus.
And that bitty advanced stake.
Right. That strategic acquisition of a 35% equity interest signals a clear intent to expand into small business financing. It's a new potential growth vertical.
Beyond growth, are they returning capital to shareholders?
They have been. They did a small $1.0 million share repurchase back in Q3 2024. More notably, they've issued special cash dividends.
Special dividends, not regular ones.
Correct. They're $1.12 per share in May 2024, and then a more substantial $1.25 per share just this past April in 2025.
What does that signal, these special dividends?
It generally suggests confidence in their cash flow generation, that they have excess cash beyond their operational and investment needs.
Okay. And how effectively are they using the capital they do deploy? How do we measure that?
A key metric here is return on invested capital, or ROIC. It tells you how much profit a company generates for every dollar invested in its operations.
And OppFi's ROIC.
It's actually pretty impressive. It was 28.10% back in September 2024, and Morningstar reports a normalized ROIC around 19.99%.
And how does that compare?
Both figures are well above their likely cost of capital. That indicates management is creating significant value with the capital they deploy. It's a strong signal of effective capital management.
Now that we know the business and the people behind it, let's really lift the hood on the numbers themselves.
Lifting the hood, a financial deep dive.
All right, let's get into the nitty-gritty. As of our analysis date, OppFi's market cap is sitting around $309.89 million based on that $11.27 share price.
Relatively small company, then, in market cap terms.
Yeah. And when we look at their revenue, it's been on a strong, consistent upward trend over the past 5 years. It's expanded significantly.
How much growth are we talking?
Well, revenues jumped from $291 million in 2020 to $526 million in 2024. Solid growth. Yeah, and after a record-breaking first quarter in 2025, management actually raised their full-year revenue guidance. They're now expecting between $563 million and $594 million for 2025.
Which translates to about
Roughly 7% to 13% year-over-year growth. So still growing, even off that larger base.
Okay, but revenue is one thing. What about profits? This brings us to a critical insight for you as a potential investor.
Lay it on us.
While OppFi boasts exceptionally strong gross margins like 85.7% and solid operating margins 18.47%,
Yeah.
there's a significant disconnect when you get down to the net profit margin.
How so?
It actually turned negative, minus 2.8% in Q1 2025.
Negative. After strong gross and operating margins, how does that work?
This discrepancy is largely due to the company's Up-C corporate structure.
Right, you mentioned that before. Explain it again.
Okay, imagine the operating company, OppFi LLC, is a highly efficient engine, generating lots of power or profit. But the publicly traded entity, OppFi Inc.,
Yeah.
the stock you buy only owns a portion of that engine.
Okay.
A substantial chunk of the operating company's profits flows directly to the original owners, who hold what's called a non-controlling interest. It doesn't flow through to the public shareholders' bottom line in the same way.
So public shareholders don't actually see all of that underlying operating profitability reflected in the net income attributable to them.
Exactly. It's a fundamental structural element that diverts a significant portion of the economic value away from the common stockholders. It makes comparing their net income to peers really difficult.
That sounds important for valuation. But despite that structure, are they generating cash?
Oh yes, OppFi is a free cash flow generating machine. Their cash from operating activities has shown a consistent upward trend.
Like how much?
It grew from $192 million in 2020 to $324 million for the full year 2024. And in Q1 2025 alone, they generated $76 million in free cash flow.
Okay, so the underlying business is throwing off a lot of cash.
Absolutely. And this strong growing cash flow is what allows them to fund their growth initiatives, pay down debt, and as we discussed, return capital through those special dividends and buybacks.
What about overall financial stability? Debt levels?
Well, they have a long track record of operating profitability, 10 consecutive years through 2024, with just one small loss in 2023. They've also consistently beaten analyst earnings estimates.
And the debt?
The debt-to-equity ratio, around 1.2 to 1.7, depending on how you measure it in Q1 2025, is high. But that's pretty typical for a finance company. Importantly, it has been trending downward.
And liquidity. Can they pay their short-term bills?
Yeah, their current ratio, a key measure of liquidity, was a strong 1.73 in Q1 2025. That indicates they have solid resources to meet short-term obligations.
Okay, so operationally strong, good cash flow, decent liquidity, but that Up-C structure complicates the net income picture.
You got it.
Now, when we talk valuation, that Up-C structure must make traditional metrics like PE tricky.
It does. Their trailing 12-month price-to-earnings ratio is negative because of that net loss attributable to public shareholders. So it's not really meaningful right now.
But what about looking forward?
Looking at forward estimates, the stock actually appears quite inexpensive. Based on 2025 earnings estimates, OppFi trades at a forward PE ratio of just 9.17.
9.17. How does that compare to the industry?
It's a significant discount. The broader financial transaction services industry trades at an average forward PE of over 22.
Wow. Okay, so potentially cheap on a forward basis if you can get comfortable with the structure and risks.
That's the crux of it. Now, to estimate a company's true underlying worth, we often use discounted cash flow, or DCF analysis.
Right, valuing future cash flows.
Exactly. The core idea is that a company's value equals the sum of all its future cash flows, discounted back to what they're worth today.
And what does your educational DCF model suggest for OppFi?
Based on our model, using a discount rate, or WACC, of 8.53%, initial EPS growth rates of about 29.5% for 2025 and 14.2% for 2026, and then settling to a terminal growth rate of 2.5%.
Okay.
Our estimated intrinsic value range for OppFi falls between $13.57 and $16.50 per share.
1350 to 1650. Interesting. Okay. With the business, management, and financials unpacked, let's zoom out to the broader market and ownership picture.
Broader landscape.
Market sentiment.
So what does Wall Street think overall? What are the analysts saying?
Generally, analysts covering OppFi have a positive view. The consensus rating is typically a moderate buy or buy.
And their price targets.
The average 12-month price target seems to be hovering around $14.67 to $14.96.
Okay, so compared to the current price of $11.27, that represents potential upside of over 30%.
Toward the analyst, yes, a decent potential upside.
But what about the media narrative? Is it all positive?
Not really. It's decidedly mixed, actually. You see company press releases consistently highlighting the good stuff: record revenues, earnings beats, operational wins.
Standard corporate PR.
Right. But then financial news outlets often focus much more on the inherent risks. Things like the high insider selling, that complex net profit issue for public shareholders we just talked about, and those persistent regulatory and credit risks.
So it creates a kind of bifurcated media tone. Good numbers, but lots of warnings.
Precisely. Fundamental achievements tempered by warnings about the structural challenges and risks.
Okay, now one of the most powerful indicators of bearish sentiment is usually short interest. How does OppFi look there?
It's high, notably high. Depending on the source and calculation, it ranges from maybe 7.59% up to a really significant 27.89% of its float being sold short.
Wow, up to nearly 28%. That indicates a substantial portion of the market is quite skeptical, actively betting against the stock.
Absolutely. It shows a stark divergence in opinion. You have bullish analysts focusing on growth, the market opportunity, the valuation.
And then bearish short sellers zeroed in on
the Up-C structure, that heavy insider selling we'll get to, and of course that huge true lender threat hanging over them.
Interesting divergence. What about technical indicators? Where's the stock trading relative to its moving averages?
Okay, so the stock price of $11.27 is currently trading below its 50-day simple moving average, which is around $12.83. That typically suggests a short-term bearish or maybe consolidation phase.
But longer term?
Longer term, it's significantly above its 200-day simple moving average, which sits around $9.80. That usually signals a longer-term bullish trend.
And are those averages trending up or down?
Both moving averages are actually sloping upwards, which further supports a positive long-term technical outlook, despite the recent dip below the 50-day.
Okay, mixed signals there too. Now, who actually owns this company, and what do their actions tell us about its future?
Ownership structure.
So who owns OppFi? Are institutions big holders?
Yeah, institutional investors hold a pretty significant chunk, around 45.24% of the shares.
Any notable names buying or selling?
It's a bit mixed, actually. We've seen some of the big players like BlackRock and Vanguard actually increasing their positions in Q1 2025. That's often seen as a bullish signal. But on the flip side, other well-known funds like Renaissance Technologies, for example, reduced their stakes during the same period. So it indicates mixed sentiment even among the big money managers.
Okay, what about insiders? Does management have skin in the game?
They do. Founder and CEO Todd Schwartz holds a controlling voting interest of approximately 69.0%. That's a lot of skin in the game, theoretically aligning management with long-term shareholder interests.
Theoretically. But you hinted at insider selling earlier.
Yeah, and this is where it gets complicated. It's a classic insider's dilemma. There's been a consistent pattern of heavy insider selling.
Oh, heavy.
Over the last 12 months, insiders have sold roughly 49.1 million shares while purchasing only about 1.1 million. That's a net disposition of nearly 48 million shares.
48 million shares sold versus bought. That's a huge imbalance.
It is. Now, it's important to note many of these sales are often pre-scheduled under 10b5-1 plans, designed for insiders to diversify their wealth over time without being accused of trading on non-public information. Okay, so maybe not necessarily a signal they lack confidence.
It's hard to say definitively, but regardless of the reason, the sheer volume of selling creates a persistent headwind for the stock price and certainly contributes to that negative market sentiment and high short interest we discussed.
Right. It doesn't look great, even if it's planned. You also mentioned voting control.
Yes. Because of the Schwartz family's significant holdings of special Class V voting stock, OppFi is actually classified as a controlled company under NYSE listing standards.
What does that mean in practice?
It means the company is exempt from certain corporate governance requirements. Like they don't need to have a majority of independent directors on their board or have certain committees composed entirely of independent directors.
So it concentrates significant power and influence with the founding family.
Exactly. Which, can be seen as positive for long-term vision or negative for minority shareholder rights and oversight. It's a double-edged sword. Definitely something for investors to be aware of. Okay, so what does this all mean for the risks ahead? Let's put it all together with a risk assessment.
Risk assessment, SWOT analysis.
All right, let's break down OppFi's position using a SWOT analysis: strengths, weaknesses, opportunities, and threats.
Okay, hit us with the strengths first.
Sure. First, that proprietary AI-driven underwriting technology. Refined over 13-plus years, billions of data points, that's a real asset. Second, their strong brand and customer loyalty, shown by that high NPS score, Trustpilot rating, BBB rating. Third, it's founder-led management with controlling ownership potential for long-term focus. And fourth, they have a proven track record of profitability at the operating company level.
Okay, solid strengths. Now the weaknesses.
Biggest one is probably high customer concentration on the subprime segment. That makes them inherently vulnerable to economic downturns. Second, that high debt-to-equity ratio, even though it's trending down. Third, the complex Up-C corporate structure that, as we've discussed, diverts profits from public shareholders. And fourth, there has been some shareholder dilution over the past year. Got it. Opportunities. Where can they grow?
Well, the addressable market is huge, roughly 60 million underserved Americans. Second, that favorable industry growth rate we mentioned, the 25.4% CAGR in alternative lending. Third, there's potential for product and market expansion, like through Bitty Advance into small business, or maybe a future OppFi card product.
Okay, plenty of opportunity.
Yeah.
But now the big one, threats.
Top of the list. Intense competition in the fintech lending space. It's brutal out there. Second, and maybe the biggest, is significant regulatory scrutiny, particularly that true lender debate. Again, that's an existential threat. Third, inherent reputational risk that comes with high APR lending, drawing constant fire from advocacy groups. And finally, that persistent negative market sentiment we see in the high short interest and the consistent insider selling.
That's a pretty comprehensive list. Building on those threats, let's quickly touch on key macroeconomic factors. High inflation must hurt their customers. Absolutely. It directly erodes the already limited purchasing power of their target demographic. Remember that average savings of just $270. High inflation makes it harder to make ends meet, increasing both the need for loans and the risk of default.
And rising interest rates.
That's a double whammy. It increases OppFi's own cost of capital, potentially squeezing their margins. And it can also impact borrowers' ability to pay back loans if rates on variable debt go up, or if OppFi has to pass on higher costs.
You also mentioned geopolitical factors earlier, specifically tariffs.
Yeah, the broad U.S. tariffs enacted in 2025 are a really interesting specific example. They're projected to increase overall consumer prices by maybe 2.0% to 2.3%.
Which translates to
An effective annual income loss of maybe $2,700 to $3,800 per household. It acts like a regressive tax, hitting lower-income households the hardest.
OppFi's core customers.
Exactly. For a family with virtually no savings buffer, that unexpected spike in the cost of living could force really difficult choices between paying for necessities and making loan repayments. It could significantly increase default rates across OppFi's portfolio.
Wow. A clear example of how external policy can directly impact their specific credit risk. Okay, it's time to bring all these threads together into our final conclusion. All right, let's synthesize the bull case for OppFi first. What are the key positives?
Okay, bulls would point to their strong position in a large, underserved market. They benefit from that powerful, data-driven tech advantage enabling scalable operations. They've built surprisingly strong brand loyalty where trust is key. It's founder-led, potentially offering a long-term vision.
And financially.
Critically, OppFi is a proven cash generator. Management seems to have a balanced capital allocation strategy: growth, buybacks, special dividends. And from a valuation standpoint, it appears to be trading at a significant discount on a forward earnings basis.
Okay, that's the bull case. Now, the bear case. What are the main arguments against the stock?
The bear case is defined by those significant, persistent risks. Number one is the paramount regulatory threat from the true lender debate could undermine the whole model. Number two, their loan portfolio is highly sensitive to economic downturns, inflation, and external shocks like those 2025 tariffs.
Competition too, right?
Absolutely. Intense competition. Then there's the complex Up-C structure, a major drawback diverting profits from public shareholders. And finally, those persistent negative market signals, high short interest, heavy insider selling suggesting deep market skepticism remains.
So bringing it back to the numbers, you mentioned the educational DCF model yielded an estimated intrinsic value range.
That's right. Our model suggested a range of $13.50 to $16.27 per share.
Okay, so what does this all mean for you, the listener?
Well, as of July 25, 2025, OppFi stock closed at $11.27 per share. That price is currently below our estimated intrinsic value range, suggesting potential undervaluation from a purely quantitative standpoint.
But it's not just about the numbers, is it?
Not at all. An investment decision in OppFi is fundamentally a judgment call on the balance of risk and reward. You have to weigh that clear upside, a well-run, profitable, growing company in a large market, trading at a low forward multiple, against the equally clear and very significant risks we spent time unpacking. The regulatory risk, the economic sensitivity, the structure.
Yeah, it really makes you think. When we consider companies operating in these markets, the ones ignored by big banks, it raises that important question. Are these innovations truly providing a lifeline? Or are they navigating waters just so treacherous that the risks might outweigh the rewards no matter how compelling the tech seems? It's a deep dive that definitely makes you think about the future of financial access and responsibility. So if you found this deep dive valuable and you want to keep betting smarter, faster, maybe consider liking and subscribing to the Stock Analytics AI YouTube channel. And did you know that for just €4.99 a month, members get priority deep dives on all of the S&P 500 stocks over the next few months? Plus, you get exclusive priority access. And hey, if you just want a one-off deep dive on a specific ticker that interests you, just drop us a super thanks.
And please remember, this analysis was generated by an AI system purely for educational purposes. It should definitely not be considered financial advice. Always, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us on the deep dive.